Hi, and welcome to the Stock Scores Market Minutes for May 2nd, 2016. All right, let's talk about how to trade as a contrarian. What does that mean? First of all, that's, I guess, the first question we have to ask. Contrarian trading means going against the crowd opinion. You hear investors talk about this all the time. When everyone else is bullish, be a bear. When everyone else is bearish, be a bull. I would say that from a trading standpoint, this only makes sense when there are signs that the crowd is wrong. And for me, the easiest way to see that is to look at a chart and look for signs that there's disagreement with the crowd, that the actual trading activity differs from what you might be hearing about on television, in the financial media, that sort of thing. When you have a bullish chart pattern where the mood is pessimistic, or a bearish chart pattern when the crowd is optimistic, you have an opportunity to trade as a contrarian. Let's use Apple as an example. I recall at the start of April, we had some pretty good optimism. The market had been going up for some time, and the general feeling was Apple was a stock that you don't trade, you own. Everyone said you have to own Apple. It's a great company, all that sort of thing. Well, that was fine in this period, but right there when the upward trend was broken, now you had evidence that some people were disagreeing with this bullish thesis on Apple. And then a few weeks later, this week, you had a gap down when Apple disappointed on earnings. And then the following day, you had Carl Icahn say that he had sold his position in Apple after being a long-time bull on the company. And the result is now the mood is very pessimistic on Apple. So when do you be the contrarian and buy Apple again? Well, you need to see signs that there's some strength coming in, despite the fact that right now the mood on Apple is pretty pessimistic. What would that look like? Well, you want to look for a break of the downward trend line, which is what happened in mid-February to kick off that upward trend. So that's how you can be a contrarian investor or trader. All right, let's get into this week's analysis. And really, Apple could be blamed for the little breakdown that we have here on the short-term chart. This is a 30-day, 60-minute chart. Each one of these candles represents 60 minutes, and you can see that on Friday afternoon when Carl Icahn was on CNBC saying that he was out of his position in Apple, that took the market down. Why? Because Apple is heavily weighted in so many of the big sector ETFs, including the SPY. It is the biggest weighting because these ETFs and these indexes are market cap weighted. And so things like the Dow, where Apple has a big percentage of the Dow, things like the S&P 500, the NASDAQ 100, when that stock falls sharply, it pulls the rest of the market down. And now, it didn't pull it down when Apple's earnings were announced because a lot of things still had upward momentum, but when Icahn said that things are looking a little bit rough for Apple because of China, well, that just kind of took the whole market lower. And so right now, I want you to be a little bit cautious, not terribly cautious yet. We have broken the upward trend, and it's a little bit of a concern because there was a falling top into that. And so my short-term outlook then is at best neutral. I think we could find some support in here. We had a little bounce back on Friday at the end of the day there, the last hour. And so we could see this come back up in here. It's a little oversold right now. But I do think short-term, the market wants to go sideways. Now, looking at the longer term, you see the problem. We've talked about this for a number of weeks now. The market is bumping up against that trend line of resistance that we've talked about many times. And you really shouldn't expect the market to just keep right on going up through that. There's a general rule that I always like to remind people: when markets rally into resistance, which it's been doing, rallying, hit resistance, they're going to get stuck. I don't know that we yet have a strong signal to jump ship on the market. We don't have a real strong break of trend like we had back here. And so for now, I think it's just a time to be cautious and not yet too worried, but let's keep an eye on it. Russell 2000 also hitting its downward trend line of resistance. It actually had broken through last week and now second guessing that break. I think we could see a little pullback here and then a continuation of this trend because I do see money rotating into the small caps out of some of the large cap leaders. Here's the Canadian market, which has been really the top performer the last little while as gold and oil have done well. And you can see the short-term trend is up, stalling a little bit here. We had a little bit of a pullback. That's fine. we can take a little break and then hopefully break through resistance in the near term. This is an optimistic chart, but really you should have been a buyer back here when the trend changed. I'm a little bit wary about buying just right now because I think that the market needs to build a base for a while. And so if this pattern looks like this, if we can build a base here and then break, that's better than breaking right away. So let's see what happens next week. Of course, the longer term chart has broken the downward trend. We've broken that a couple of months ago. We're now in an upward trend. Relatively short term, still got lots of resistance to move through, but it's a positive sign for the Canadian market, which has been an outperformer in the last couple of months. TSX Venture, of course, the small cap, micro cap Canadian stocks in a nice upward trend right now. And that is because of gold and oil, primarily gold, because the miners are doing so well right now after being just terrible for so long. But it's coming into resistance. I didn't draw that very well. Let's try that again. Resistance right about in here. So you should see this market get stuck in the next week or two. But there's still lots of action in individual stocks and certainly a fun place to play again after it had been weak for so long. Treasuries had broken an upward trend here. That meant that interest rates looked a little higher. This week we got a little bit of a reversal of that, but I don't think it's one to really speak highly of. We're still stalling under resistance in a bit of a trading range right now. We need to see either a break out through there or a break down through here. Of course, down through here means interest rates are going up. Up through here means interest rates are going down because, of course, there's an inverse relationship between treasury bond prices and interest rates. US dollar, very important break this week because we've cleared through these lows here, which was support. We have pessimism. Now we've broken through. That points to the US dollar moving lower in the next little while. That doesn't mean next week it moves lower. Oftentimes when you get a negative week, you'll get the market bounce back a little bit. And we had really a negative week this week as Japan opted not to do some of the stimulative action that the market expected. That meant the yen go up. Of course, with the yen going up, the US dollar goes down. That's helped things like gold and oil, although gold more so. And speaking of gold, here's the chart. This is a really important chart this week because the downward trend was broken. We talked about that back in late January, early February. We've now built a rising bottom, and this week we are breaking up from a rising bottom. That points to higher prices in gold. Now keep in mind, I have been a bear on gold all of this period and much longer. So I have started to turn bullish on gold when we broke the trend, and now again this week I think you have to be more bullish on gold. Short term next week, wouldn't be surprised if we see a little pullback because of the intensity of the run Thursday and Friday. But I do think gold looks like it wants to go higher here, and that is good for the gold stocks. Gold stocks very overbought right now. I'd like to buy them on a pullback rather than chase them higher. All right, oil has broken its downward trend, building a rising bottom, but it hasn't shown the excitement to the upside that we've seen in gold. It's kind of trickling higher as opposed to people saying, yay, I love oil. It's sort of, well, let's slowly cover our short positions type of a rally in oil. It's good, but it's not great. And so I don't want you to be too optimistic on oil, but certainly money is moving into the group. Finally, the fear chart, which is the VXX based on the VIX. And you can see we had a little bump up Thursday and Friday. I don't think it's a real strong break yet, not one that says we need to run for the hills, but still deserving of some caution on the stock market because, of course, this goes up when fear is increasing, and that can often preclude or come before a drop in the stock market. And if the market does drop, this is a great place to trade. So if you see weakness in the days and weeks ahead, focus on the VIX because that's where you can really make a lot of money from a market correction. So my ratings then, I've dropped to neutral on both time frames on the US stock market simply because we're hitting resistance, we're getting stuck, and that could roll over where this has to actually go bearish. On the Canadian market, bullish, a little overbought, so I want you to be cautious. Don't chase things higher. Maybe buy on pullbacks as opposed to chasing things that have been going up for some time. Gold, similar situation, bullish on both time frames, kind of trending pretty strong the last few days, due for some profit taking. No sign of profit taking yet, so stick with the bullish trend. Just realize that there's a better opportunity when a market pulls back and then breaks the pullback. That's when you want to be adding if you didn't pick it up when it started its upward trend. Neutral on both time frames and oil. I would say on the optimistic side of neutral. Looks pretty good, but not as good as gold. Commodities continue to lead from low levels as the US dollar moves lower. This is helping the Canadian market lead the US, which is hitting long-term resistance and stalling its upward momentum. Gold looks good longer term, but may see profit taking in the short term. Volatility starting to pick up, which shows a little bit of fear creeping in the market. Not a major concern yet, but something to keep an eye on. Well, a reminder, follow me on Twitter, subscribe to my YouTube channel, and we'll see you next week. As I always like to say, trade well.